In today's video, I'm going to be talking about how to protect your wealth from future Labour tax raids. I'm actually going to be using an article from the Financial Times, as you can see on my screen here. Now, if I was a journalist, I think I might have actually added in the word possible. How to protect your wealth from possible future Labour tax raids. Because from my understanding, unless the FT know it's something that I don't, there's been no talk or communication from the Labour government, and this is somewhat speculation at this point in time. However, speculation comes from obviously history and comes from the Labour government versus Conservatives, and also the massive deficit which the UK government has in terms of its funding budget. So I'm going to dive into a couple of the ideas here which have been outlined in the Financial Times of ways in which you could potentially avoid these taxes from hitting you over the course of the Labour Party being in power for however many terms that may be. So the first one I'm talking about is capital gains tax. Okay, now they're suggesting that if capital gains tax were to be added in more places, or the rate of it to be increased, or capital gains tax to be added to more types of investment policies, maybe now could be a good time, for example, to take the capital gain. For example, if you have an S&P 500 iShares portfolio fund, I should say, and it's grown by 20%. What if you sold that fund now, took it back to cash in your account, and you could buy the same fund again, and the capital gain would obviously happen now at this point in time. Now, capital gains tax is obviously not applicable to pensions, not applicable to ISAs, but it is applicable to general investment accounts and other bits and pieces. So that's one sort of idea from the Financial Times, which isn't necessarily a bad idea. The only problem with that though is you would be taking yourself potentially out of the market for a period of time. If we have a look at the statistics and the data, missing just the 20 largest growth days over the course of the last 30 years can have a dramatic effect upon your portfolio. So coming out of the market is not something I often advise to clients unless you really need to. The second point they've raised here, which is quite interesting, is regarding inheritance tax, right? Now, as per the advice I'm giving to a lot of my clients, and many of my clients and many of the people I work with are in such a favourable position with their financial planning that whilst their pension pot is meant to be their pension, they actually have no intentions of drawing down that capital for their pension. Say they have ISAs, say they have GIAs, say they have investment properties that they're looking to sell. All of those things would form part of their estate for inheritance tax planning when they pass away, in comparison to a UK pension pot such as a SIP, a self-invested personal pension, where that will not form part of your estate. So a lot of my clients are leaving their SIPPs to give to their beneficiaries, whether that be their spouse, their children, grandchildren, etc. So what we have to understand here is that potentially something that the Labour government or any government could look at in the future to try to say, actually, we're going to be changing the rules on UK pension pots, typically passing on to beneficiaries free of inheritance tax? I'd say the answer to that is it's possible. Again, it's speculation. There's no information online from Labour potentially having this as an idea, but it's certainly something which is worth bearing in mind. The third point they talk about here is again related to inheritance and accelerating your inheritance strategy. Advisors have long encouraged giving while living to reduce inheritance tax bills and start a 7-year clock on potentially exempt transfers. Political change has added new urgency, they say. Some wealthy families of large estates have been accelerating the transfer of assets to younger generations out of fear to IHT change under Labour government. Again, I think there's some rationale there from the Financial Times in why they're suggesting this. If you look at, for example, compare the US to the UK. In America, you can pass on circa 10 or $11 million in terms of assets before inheritance tax becomes an issue. In the United Kingdom, it's £325,000 per individual or £650,000 per couple. That affects a lot of people. If you have a main residence and your postcode is anywhere near London or other parts of the country as well, your property may well take you over that threshold already for your family, even with the main residence allowance. So it really is something which I think is important, but also, even if we forget inheritance tax, the conversation I'm having with a lot of my clients is, look, I know you might not want to tell your kids how much money you have, or maybe you think by telling your kids how much money they're going to get, maybe it's going to stop them being motivated in life. Or maybe you don't think they deserve it. You think they should have to work and grow up like you did. Whatever it is, If you can get past any of those things in your mind, giving now is potentially far more valuable. If you're in your 40s, your 50s, your 60s, statistically speaking, the chances are you're probably going to live into your 80s. As such, from a 7-year rule perspective, you're potentially far better off considering gifting now at this earlier stage than coming to me when you're 70s and your 80s and say, oh, I want to gift now. Yes, you can still gift them, but the potential chance of you having inheritance tax applied over the course of that 7-year scale is obviously far increased. If you want to have a conversation with myself or one of our senior advisors about inheritance tax planning, you can get in touch below. Inheritance tax planning is obviously an unregulated area of financial advice, but some of the solutions that it may recommend may be regulated. Okay, so into the nut part here, they're talking about school fees, okay? Now, this is a really big topic at the moment, and I've had 3 or 4 clients ask me, Dominic, how do I get away from not paying my school fees? Obviously, some schools are offering the ability to pay your school fees in advance. I'm not quite sure about that. It would have to be very well worded document for the Labour government or any government not to just see that as a blatant way of trying to avoid taxes by paying for things in advance. So I'm not sure that's a foolproof strategy, as the FT comment on here. One thing that could be interesting in that is in terms of gifting again though. So for example, from grandparents, etc., gifting money, passing on to kids, potentially for kids to obviously contribute towards their school fees. I hope you found this video interesting today. There's a lot of change going on at the moment. I'm sure we'll see over the course of Labour's term if there are going to be any changes to pension legislation, particularly taxes. I look forward to hearing in the comment section below any questions you may have or any videos that you'd like me to do. Thank you, and as always, take care with your UK pension assets.